This is an undeniable sign that a financial crisis is already unfolding. Now, let's head over to Bloomberg, where we picked today's story up of the headline as junky as junk is offering a warning sign for debt. And I want you to understand why this is so important is because financial crises always start at the bottom. I want you to think back to the global financial crisis. Where did it start? With subprime mortgages. There's a reason we talk about subprime autos on this show and the risk it has to a lot of community banks. And now when you see headlines like this, what it's telling you is that a financial crisis has already started. And as you're about to see, it's going to get worse and fast. The lowest rung of junk bonds are flashing warnings that the U.S. economy could soon face slower growth and higher inflation, as well as the possibility of a recession. And the risk for slower growth is you start to see delinquencies rise in the junk space that quickly turn into defaults. So what we're seeing in the bond market right now are very clear signs that a recession is starting to get priced in. And remember, it starts at the bottom and then accelerates from there. Risk premiums on junk bonds rated in the triple C tier have widened 1.56 percentage points this year. This gap between spread on triple C's and the next tier above them B's has been widening this year in the last 2 weeks, signaling that the weakest bonds are lagging. So the market's starting to price in that these bonds are going to default, and it starts to make perfect sense because when you look at the U.S. economy and the global economy, we're seeing clear signs it's decelerating amidst higher inflation. Now we know exactly what happens when demand goes down and prices go up. We go right into a recession, and what happens due to the lack of money, the lack of revenue from these firms, well, they end up going into delinquency and into default, and that's exactly what you're seeing here as spreads start to widen. The market's starting to say a financial crisis has already begun. The triple C widening and underperformance are red flags, and this are only going to get worse as you're about to see. Jamie Dimon, who was early to spot risks in the mortgage market during the U.S. housing bubble, said that on Monday, credit spreads aren't accounting for the impacts of a potential downturn. He added that the chances of elevated inflation and stagflation are greater than people think, and cautioned that America's asset prices remain high. Well, the risk of elevated inflation, well, is highly unlikely because there's an issue with the economy, and that is consumers can't afford prices where they're at now. They most certainly can't afford them if they go up. Now, we can look back to the global financial crisis and we saw the impact of higher energy prices. It pulled money from the discretionary side of the economy and ultimately led to deflation. So in the short term, yes, we can see prices go up, but they're not going to last. So what he is accurately telling us here is that we're facing a stagflationary recession, one that's also going to see the unemployment rate go up. And the evidence for facing stagnation is very clear as we look at the consumer price index against real retail sales as shown in red. We can go back to periods like the mid-90s where we see inflation rising and that eats into consumer budgets. We see retail sales sort of languish there. How about as we go into the dot-com bubble, you see rising inflation, slowing retail sales. This is a very clear sign that consumers can't afford higher prices. And this is exactly what the bond market's telling us because a lot of these junk firms, they need revenue. They're chasing one sale to the next to stay afloat, and if they don't see the revenue they need to pay on the bonds, well, they're going to go into insolvency, they're going to default, and that's exactly what you're seeing. The credit spreads are starting to tell us. We see the same thing happen going the global financial crisis as rising energy prices pull money from the discretionary side of the economy. It happens around 2012 into 2014. We see it happen around 2018, and now we're seeing it happen again. Even though real retail sales have been only flat over the past few years, the reality is it's being held up because inflation's coming down. Now the risk is due to the tariffs that we're likely to see inflation rise. At the time, we're not seeing incomes go up. We're not seeing hours worked rise, telling us that consumers are going to reject these, and now it starts to make sense again. Why credit spreads on the junkiest of junk are starting to blow out? Because default is starting to come into play. Credit is a bad risk, Jamie Dimon said. The people who haven't been through a major downturn are missing the point about what can happen in credit, and that means the price of junk debt can absolutely plunge. You see interest rates go up as banks and lenders start to demand a higher interest rate to compensate for the risk of the bond. And this is exactly the opposite of what you see in the Treasury market. When you're in a risk-off mode, when you're facing a crisis, you see rates on Treasuries go down and bond prices go up. The exact opposite happens for treasuries. And what this is signaling is, again, we're in the early stages of financial crisis that, as you're about to see, are only going to get worse. But something that should be going up is your trading account, and a lot, because just because junk yields are likely to rise doesn't mean you can't make money in this market. Let's go back to April 24th. We told our CTA Timer Pro subscribers to buy uranium on the open. They're up as of Friday's close 18.93%, and the news on uranium is extremely bullish, and we think this can now go even higher. Now, if you want to trade against machines and win, grab the links in the description below. Use the coupon code for your free 30-day trial. Stay tuned to the end of the show to learn how you can make big money being machines. As U.S. Treasuries hold gains, as Besant says, the supplementary leverage ratio moves are very close. And I want you to understand that Besant ran a hedge fund, and he very much is clear on what's going on in the debt markets. He's an expert in the space. So when he starts to see spreads widen, he knows this is a sign that we're heading into a recession. So what is his move? He wants to bring rates down to keep these bonds from going into default. Now, he has no control over the junk space, but he has some leverage, some power as a Treasury Secretary over the bond market. Besant said that an easing of bank capital rules on treasuries could happen this summer. He also said the U.S. could strike several large trade deals in the next couple of weeks and downplayed the risk tied to debt dynamics. So I want you to understand there's two pieces here. The supplemental leverage ratio, if the rules were relaxed, what it's going to do is allow the commercial banks to start to buy more treasuries, because right now they have to reserve cash against things like risk-free treasuries. According to the Basel III rules, this would mean going forward they would not have to hold cash against that cash potentially could be used to buy more treasuries. But there's a secondary issue that's facing the junk space, and it's the trade war. Because remember what happens when you put big walls up, you see trade and demand go down. And for a lot of these companies that issue junk debt, they run on very thin margins, looking to roll this debt over, roll over sales and goods and services as fast as they can so they can meet their debt payments. The slowing economy, due to, of course, the tariffs that we have no sign that they're going to end anytime soon, is the biggest risk right now for the junk bond market. So again, as we see spreads starting to widen, it's a very clear sign that the default risk of these bonds are rising. And when that happens, it starts to spiral out of control. Next thing you know, it'll get into the junk B space, and then it'll spiral completely out of control. Besant downplayed deficit forecasts they said failed to incorporate the possibility of stronger economic growth and tariff income, calling Moody's actions a lagging indicator of fiscal health. Of course, the risk is that he's not factoring here is that what if the tariffs, what if pulling forward all this demand going back to the pandemic, pulling demand forward from front running the tariffs, puts us in a position where the global economy and the U.S. economy hit a massive air pocket where demand plunges. His case is, look, we need to get things passed through here because we're not factoring the economic boom that's coming. The reality is what we're seeing in the junk space is the bond market is telling us that the higher probability isn't an economic boom, because if that was the case, we'd see junk yields coming down. We see bond prices going up. Instead, what they're saying is he's wrong. The SLR reforms are incrementally going to improve the Treasury demand by banks, but banks are unlikely to be marginal buyers of Treasuries when auction sizes go up to finance the deficits. Couldn't disagree more with that, because if the base case, what we're seeing in the bond market here, the beginning stages of a financial crisis, if this is correct, then what it tells us, the banks are going to be massive buyers of all kinds of government debt. Let's take a look at real GDP in blue against Treasury and agency securities at all commercial banks, both shown on a year-over-year rate of change. And I want you to see very clearly that when you see growth slow down, that means the blue line headed to the downside, even below the horizontal black line where there's a contraction. What do you see? The red line going up. And what that means is banks are buying treasuries. They're driving rates down. They're going into risk-off mode. And you see that happen each and every time. So the notion here that the banks aren't going to be buying bonds, well, if the base case, again, what the bond market is telling us is that we're heading into a financial crisis, you can better believe the banks are going to be massive buyers of bonds, just not junk bonds. And yet the risk is, what we're seeing in the economy, what the bond market is clearly telling us, is that Trump's new tariff threat shows that trade uncertainty may be here to stay. And again, for a lot of these companies that issue junk debt, they don't have the cash, they don't have the margin. That's why they pay high interest rates. So you think about, why do people get a subprime automobile loan? Because they have no other choice. They don't have the income, they don't have the credit, they don't have the cash. Same reason people get subprime home loans. They don't have all the things they need to keep the banks in a position where they believe the loan will get paid back. So you have to pay an interest premium, and that is the risk here, because as long as this uncertainty continues to go forward with the trade war, what it means is demand's likely to come down, and a lot of these companies just don't have the cash flow or the money to keep their bonds from going default. The Sen said in the same interview that many deals are nearing conclusion and labeled the EU as an exception. And that echoed comments from Commerce Secretary Howard Lutnick, who said at the Axios event earlier this week that the EU has been very difficult. Yet longtime Trump ally Steve Bannon said the president's reaction was in part due to what he saw as a lack of progress on trade issues this week, mainly referring to the European Union, as particularly the relatively quick deal the president was hoping to strike with the UK would pass on to other countries. Bannon said that other countries without deals in progress should be worried, calling it a storm warning. I want to know from you, what do you think about what's going on? Do you think we're bluffing? Do you think we should hold out? Where are you at on the trade war? Do you want it to end now, or are you in it to win it for the long term? Weigh in the comments below, and what do you think the economic impact of your opinion will be? Love to know from you. Because it will all be for naught, Goldman says, as higher bilateral tariffs are unlikely to drive a substantial increase in domestic and production. And that was a stated goal of President Trump's plan, and that's what the bond market is starting to tell us. While there is this belief that, yes, this is going to lead to domestic demand, these companies that are holding this junk debt, well, the bond market is saying, look, it's not going to happen. And if it does, it's not going to happen anywhere in the near term, meaning that the high probability that these bonds start to go into default is building every day. And if they do, it's going to spread like wildfire through the U.S. financial system and then all throughout the world. And Trump risks U.S. consumer discontent with his tariffs. And here's the problem. When consumers are discontent, they quit spending. So you can see this always coming right back to the trade war that we don't have an answer to yet, that needs to be resolved quickly, because what Jamie Dimon is warning about very clearly, these junk spreads that are blowing out, well, this is a fire that if it's not put out and soon, it's going to turn into a raging inferno. A majority of U.S. adults, 56%, said their household finance would be better off if Trump's tariffs had not been implemented. Some 52% of respondents said the promised benefits of the levies would not be worth their economic cost. I want to know from you, are you in that 50% group that think things would be better without the tariffs, or do you think things are better for you because of them? What is your opinion? Weigh in the comments below. Again, love to hear from you on what's going on in the real world. As Trump's tariff negotiations play out, some consumers are choosing to reduce their spending preemptively, girding for further price hikes that could hit their budgets. And again, this is a big problem. What the junk space is clearly telling us, that as demand goes down, revenues from these firms, they go down as well. Their ability to make their debt payments go down. And next thing you know, the bond prices start to collapse. You see interest rates on junk debt start to rise. The spreads start to get wider. And next thing you know, the moment they can't afford to pay and you start to see the defaults begin, it's a domino effect right through the financial system. And Walmart this month said the shoppers will start to see higher prices as it begins to pass on the cost of newer merchandise. And price increases, Walmart said, are happening right now, and they'll become more obvious. So again, you look at this from the consumer perspective. Their incomes relative to inflation are shrinking. And here, what we're hearing from Walmart now is prices are going to go up. That means demand's going to go down. And for junk debt, it's going to be a bigger problem. Even Target cut its sales forecast this week after it saw a sharp pullback in consumer spending. And keep in mind, Target is a big retailer on the discretionary side of the economy. So while, yes, there were some boycotts and maybe some other factors here, they are still a big part of the discretionary economy. So what they're telling us very clearly is consumers are spending more on things like rent, food, and energy that's going up in price, and spending less on discretionary. And again, it's going to backfeed through the economy. And again, exactly what the bond market is clearly telling us right now. And you can see the effect of when you have rising prices and shrinking paychecks as we take a look at the CPI in blue against average weekly hours of production and non-supervisory employees in red. And it's very clear, as hours worked go down and prices go up, you go into recession. This is what Jamie Dimon was talking about, stagnation, because what we're seeing right now is the economy slow down. Here you see rising inflation, fewer hours worked going to the dot-com bubble, happened again during the global financial crisis. And right now what we're hearing from Walmart and Target, prices going up, hours work going down. Again, the risks here now for the economy are high. You can see exactly why the bond market is warning we're facing a potential all-out financial crisis, one that is saying it's already begun. And although about half of Americans say they have plans to travel this summer, a third of those people say they have fewer trips booked for this year compared to last summer. Again, telling us very clearly that the discretionary side of the economy is going to take a hit. This means a lot of people in the service-related industries are first going to see their hours cut. Then we're going to see job cuts. It's going to have a massive impact, not just on the U.S. economy, but the global economy. And again, we come back to right where we started. You think about what happened during the global financial crisis. It was led by subprime mortgages. We have the risk of subprime autos blowing up. And right now, subprime junk is telling us that we're beginning stages of financial crisis. But just because we're in the beginning stages doesn't mean you can't profit in a major way. Let's check out that trade on uranium we put to our TTA Timer Pro subscribers. And while we noted there was a left shoulder, head, and a right shoulder chart pattern, it was the breakout above it where we saw the machines were likely to turn into big buyers, and they did, driving price right up to a 6-month volume profile. And again, we told you on this show and our subscribers that if this holds, it's going to send prices up. And then on news from the Trump administration, the nuclear is going to be a big force going forward. We saw a massive gap up move, and now we believe prices could head even higher. Now, how do we do this? Each and every day we run a screen of the machine positioning across the broad equity, bond, currency, and commodity markets, and then we look at each signal that we back tested and we put out on our hot list the ones that have the highest probability of turning a profitable trade. But in addition to the hot list, you also get all the machine positioning across all the different sectors. You get the daily report. You get the tradable signals. I review all of the trades and give you my opinions on the best trades. I give you risk control levels, a full tracking of all the trades and returns, a weekly update. And here's the best part. We're so confident that you can make big money trading against the machines and winning that we want your first 30 days to be on me. Grab the links in the description below. Use the coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.